Imagine opening your wardrobe in the morning. The t-shirt, jeans, sneakers, handbag, sportswear, even the trendy brand you scroll past on your phone. All of that sits inside the apparel, footwear, and lifestyle sector. This sector covers everyday basics like socks and underwear, fashion and workwear, sportswear and sneakers, handbags and lifestyle accessories, and the digital fashion platforms that sell them. At its core, these businesses take design, branding, and supply chain execution and turn them into products people wear every day or use to signal identity, status, and lifestyle. It's a huge part of global consumer discretionary spending and a massive employer across both retail and manufacturing. In 2024, the global apparel market is around 1.77 trillion US dollars and is expected to reach about 2.26 trillion by 2030, which is roughly 4.2% annual growth between 2025 and 2030. The global footwear market is about $423 billion in 2024 and is forecast to reach around $618 billion by 2033, which is about 4.3% annual growth from 2025 to 2033. Put together, apparel plus footwear today is roughly a $2.2 trillion global sector. Regionally, Asia-Pacific is the largest apparel and footwear region by revenue and also dominates manufacturing. North America, mainly the United States and Europe, are very large branded and fashion markets with high spending per person. Emerging markets like Latin America, the Middle East, Africa, and South or Southeast Asia are smaller in dollar terms, but growing faster as incomes rise and fashion spending moves into more formal, branded channels. How the sector makes money and what the numbers look like. Broadly, there are 5 big business model types. First, brand-led apparel and lifestyle companies that design and market products, often outsource manufacturing, and sell via wholesale, their own stores, and e-commerce. Second, footwear and sportswear brands with similar models, but more focused on shoes, performance technology, and athlete or celebrity endorsements. Third, online and digital-first platforms, e-commerce sites, marketplaces, rental and resale platforms that are asset-light but heavy on data, logistics, and marketing. Fourth, off-price and value retailers that buy branded or private label inventory cheaply and sell it at discounts. And finally, the textile and manufacturing supply chain, mills, yarn, fabric, and cut-and-sew manufacturers that sit upstream and sell business to business. On the brand and retail side, for reasonably healthy apparel and footwear retailers and brands, gross margins are usually around 50 to 60% of sales. Operating margins are roughly 10 to 20%, with the very best fashion houses higher and weaker players lower. Net margins often land in the 5 to 10% range in good years. Their major expense buckets are fairly consistent. Cost of goods sold, inventory, manufacturing, and sourcing typically sits around 40 to 50% of sales. Store labor often takes 10 to 15%. Occupancy costs like rent, utilities, and store overhead are usually another 10 to 15%. Distribution and logistics and marketing and promotions each often run around 5 to 10% of sales. Upstream, textiles and manufacturing are much thinner margin businesses. Gross margins there are often around 10 to 15%, and net margins are typically in the low single digits. Apparel is set to grow 3 to 4% annually, footwear 4 to 5%, online fashion 7 to 9%, and off-price 9 to 10%. Blended together, the sector likely grows about 4 to 6% a year over the next 3 to 5 years, and around 4 to 5% over the longer term. Now that we've covered the sector's size, models, and growth, we'll break it into 5 investor-friendly building blocks. Global apparel and lifestyle brands include global and regional apparel brands in areas like casual wear, denim, workwear, and contemporary fashion. They also include lifestyle and specialty retailers built around a particular look or tribe, such as youth fashion, athleisure without heavy footwear, resort styles, or preppy aesthetics. These companies usually design in-house, manage sourcing and branding, and then sell via a mix of wholesale, owned stores and outlets, and their own websites or apps. That means they are mostly consumer-facing, close to the end customer, while much of the textile and sewing work is outsourced to Asia or other global suppliers. Their revenue model is straightforward. They sell apparel and soft accessories at a markup, either to wholesale partners or directly to consumers. Wholesale revenue usually offers lower gross margins but is less capital intensive, while direct-to-consumer sales through stores and e-commerce earn higher gross margins but come with more fixed costs. Footwear and sportswear brands include global sportswear giants focused on performance shoes, apparel, and equipment. Lifestyle and sneaker-led brands that center around casual shoes, sandals, and boots, and outdoor and performance footwear brands focused on hiking, trail, and specialist uses. These companies make most of their money by selling footwear and sportswear at a strong markup to wholesale partners and through direct-to-consumer channels. Licensing, endorsements, and collaborations support the brand image but are smaller contributors to revenue. Their growth is driven by sports participation, fitness trends, and the broader rise of athleisure, by innovation in cushioning, performance, and sustainability, including new materials, by deeper penetration in emerging markets, and by sneaker culture, where collectible releases can drive pricing power. The footwear market as a whole is about $423 billion in 2024 and expected to grow to around $618 billion by 2033, implying roughly 4.3% compound annual growth. When we talk about online and digital-first fashion, we mean digital native brands, marketplaces, resale and rental platforms, and broader e-commerce where apparel is a key focus. They make money through inventory margins, marketplace commissions, subscriptions, and ad or logistics services. Online fashion is already about $500 to $550 billion and is expected to roughly double by the early 2030s, which is around 8% annual growth. For investors, the big levers are unit economics, especially CAC versus LTV, returns rates, and regulatory risk. Off-price and value fashion retailers include off-price chains selling branded goods at discounts, value and dollar retailers with significant apparel and footwear mixes, and mass merchandisers where fashion is a major category. Their model is simple: buy closeouts, excess inventory, canceled orders, and private label goods at very low cost, then sell them at discounts to full-price retail. Globally, off-price is one of the fastest-growing segments, expanding from about $320 billion in 2024 to roughly $690 billion by 2032, a 9 to 10% CAGR led by the U.S. It's also more resilient and often counter-cyclical, though heavily dependent on steady inventory access and strong store economics. When we talk about textiles, manufacturing, and apparel supply, we're talking about the upstream backbone of the sector: mills, fabric finishers, OEM or ODM factories, and integrated basics producers, making t-shirts, underwear, and other commodity garments. These are B2B businesses, selling yarn, fabrics, and finished garments to brands and retailers through contracts or spot orders. The global textile market is about $1.0 to $1.1 trillion in 2024, growing around 4 to 7%, and apparel manufacturing is a $500 billion-plus industry in 2025, heavily concentrated in Asia. Margins are thin, input costs and working capital needs are high, so a strong cost position, tight financial discipline, and solid ESG and compliance are critical for long-term investors. Across the whole sector, a combined view suggests revenue growth of about 4 to 6% per year over the next 3 to 5 years, and around 4 to 5% over the next 5 to 10 years, as mature markets slow a bit, but emerging markets and online remain strong. Structural tailwinds include a rising middle class in emerging markets, the shift to online, mobile, and social commerce, and powerful trends in athleisure, health and wellness, and casualization. Sustainability and circular fashion are longer-term tailwinds and risks, pushing innovation in materials, recycling, and new models such as resale and rental. On the risk side, ultra-fast fashion and oversupply, regulation, trade policy and tariffs, macro volatility, inflation, and wallet squeeze, and ESG and reputational risk all matter. If you understand how each block makes money, where its margins sit, how cyclical it is, and what specific tailwinds or headwinds it faces, you can move from simply liking a brand to judging whether that stock in that block is likely to create value through a full cycle.